Hello, everybody. We've just kicked over 2 minutes past 11:30. Welcome, good morning, and thank you all for joining us for our first quarterly economic update with BetaShares this year. My name is Laura Scrigner, and I, of course, work here at BetaShares. But on the line, we have David Bassanese, our Chief Economist, taking you through today's presentation. The presentation title, I think it's one we've all been hearing about lately. Is it a soft landing with a question mark? Now, before we do go ahead and commence, there are some housekeeping things I do need to mention. Now, of course, all information provided today is general in nature and doesn't take into account your specific circumstances. Should you need support there, please do engage a financial advisor. Now, you will receive a recording of the webinar post-completion, and that one will be sent to your email. It'll also be available on the website. So should you want to go over any of the content that we've got today, please stand by for that. And on the right-hand side of the screen, you'll see there's a chat box icon as well, and we absolutely do encourage all questions throughout the presentation. We will be having a Q&A session towards the end, so please do utilize that. Now, as you know, BetaShares, we are very regular on all socials. And if you haven't already signed up for our weekly Insights article, it is the #1 most read article from an ETF manager. We've got a QR code there on the screen, so you'll be able to sign up easier. And of course, you can catch us on all the socials, so LinkedIn, Meta, and the like. And we absolutely love hearing from our investors on there. So feel free to give us a follow and send us a message. Now, I think perhaps it's a good time to talk a little bit to the BetaShares journey and where we are now. I'm sure you've been a part of that journey and seen us grow. We've just ticked over $35 billion in assets under management and now have over 1 million Australian investors. And with that, we all know that there's specific, unique demands for, particular ETFs. So we're proud to have over 90 different ETFs available for you to choose from. Now, just going over to the next slide, you can see there that BetaShares sits pretty high, which is great, but I think this slide speaks more broadly to ETF adoption within Australia. Some of those big names you can see there are either in the ETF space or starting to open up ETFs there. So it's a bit of a good news story by way of ETFs. And just to visualize that just over in the next slide, 37.5% market share, or 37.5% of investors trusting and utilizing BetaShares within their portfolios as well, which is just great. But I'm sure you're all tired of hearing from me, so I will pass it over to David Bassanese to commence the presentation, and I'll be back at the end to run questions.
Thanks very much, Laura. Great to be with you all for the first quarterly economic webinar of the year. I've broken up the presentation today, 3 elements. Let's go through these scenarios, and I'm sure if you read the financial press, you've heard this well-worn phrase now: soft landing, hard landing, no landing. I just thought I'd go into what that sort of means in terms of economic different sort of scenarios, what that means for asset classes, and then give you my probabilities in terms of which ones will play out and why, the risks around that, and then what that means for financial markets, and then some investment ideas associated with that. So firstly, just a bit of a fun slide here. For those that may not know, that head there, that's the face of Jerome Powell, who's the US Federal Reserve Chairman, sort of like the Reserve Bank Governor of the United States. And he's basically been photoshopped into a George Bush post of the Iraq War, where it was like, everyone was jubilant that they'd won the war very quickly, at least won the battle, and it was like mission accomplished. And we all know, the Iraq War, there's a lot more complications that followed thereafter. But anyway, in Wall Street at the moment, it seems there's a little bit of that sort of sense of jubilation that, inflation is coming down. Maybe we've done the job, or we're close to doing the job, and we don't need to have a recession. So anyway, I just thought that's the sort of fun question. Well, I wouldn't say fun, but that is the question at the moment. Is it really mission accomplished in terms of tackling inflation, or are there a lot more potholes ahead? I'm cautiously optimistic, to cut to the chase. For a year or so, I've been, cautiously pessimistic, worrying that the US would need a recession. But for reasons I'll go into today, it's looking less and less likely that inflation per se will be the driver of that recession. We will ultimately get an economic downturn again. History suggests they do eventually come around with impact for markets, but at the moment, it's looking fairly encouraging. So these are different scenarios in terms of soft landing, hard landing, and really you can think of, when you think of the economy, you can break it up into two dimensions. Firstly, is economic growth strong or weak? That's point one. And the second point is inflation, high or low? And so firstly, if you've got very strong economic growth, rising inflation, a hot economy, that's sort of seen as overheating, and that's generally bad for bonds because central banks are raising interest rates to slow the economy. Can be good or bad for equities because rising interest rates is not good for equity valuations, but a strong economy is good for corporate earnings. So it can be mixed. On balance, it's usually negative, certainly if you're later stages of the cycle. And some of the risks around that, we do have some of those risks. Services inflation globally has come down. It's still not back to pre-pandemic levels. Consumer spending still somewhat resilient. So that is if we see those sort of things, that risks overheating. It means, pressure on bond markets continuing, some pressure on the equity market. Stagflation is one where you've got high inflation, also high inflation, but weak economic growth. Really, it's the worst of all worlds. The sort of thing we saw in the 70s when oil prices surged. And so, again, the big risk there is geopolitical shocks today. If, for example, the war in Ukraine escalated through Europe, the Middle East tensions escalated, so there was major disruption of oil prices, oil supply, and oil prices went up to $150, $200 a barrel. Heaven forbid, the price of petrol here doubled or tripled. You'd be in that sort of stagflationary environment, which would be, again, bad for bonds because interest rates would be going up. Central banks would be needing to sort of raise rates to contain that, but it also corporate earnings would be hurt. So bad for bonds, bad for equities, and you want to hunker down into things like cash and maybe some commodity type currencies, commodity exposures. The other one, of course, is recession, where it's like low inflation, which is good. But weak economic growth, which is bad. And so that's what we've been fearing. We've been fearing that the rate rises would cause, the economy to tumble into recession, would get inflation down, which is good. But the recession, weak economic growth would be bad. And that's, the risk in that sense at the moment is the lagged impact of the policy tightening we've seen today. Aggressive tightening around the world. And that if that slowly, percolates through the economy and suddenly we get a major slowing in economic growth, that's been the risk. Hasn't happened so far. Obviously, there's been some slowing, particularly in Australia in terms of consumer spending, but overall unemployment rates around the world are still pretty low. Last but not least is this, the nirvana, the thing we've been hoping for is reasonable growth. I mean, when we say soft landing, people talk about below trend growth, like a period of weakish growth, but not recession. It actually doesn't need to be that soft. What really matters is that inflation still comes down. So if growth is okay, we're out of recession, but inflation is still coming down, then we're in the soft landing camp, which is good for bonds because it means central banks don't need to raise rates, they can start cutting rates. And it's also good for equity markets, of course, because lower bond yields is good for valuations and okay growth is good for corporate earnings. So that's really the lay of the land in terms of all the different scenarios. And just to summarize, soft landing is good for bonds and equities. A recession is good for bonds because central banks have to cut rates. It's bad for equities. Overheating is bad for bonds. Mixed for equities, but probably bad. And stagflation is both bad for equities and bonds. And so where we want it to be in that soft landing. And the good news is that I think there is a growing chance that we can get to that soft landing scenario. So that's where I'm seeing the higher risk at the moment. And just in terms of forecasting, as an example, the US central bank has the expectation that the unemployment rate will tick up a little bit. It's around about 3.7% at the moment, and they expect it to get up to 4.1 at the end of the year. but inflation still coming down, core PCE, core inflation coming down to 2.4%. So I think if we end the year with US unemployment sub 4.25, as you can see there, and inflation sub 2.5, we are in that soft landing camp. Anything else would be in different types of camps. For example, a recession, I think if the unemployment rate went over 4.25, but inflation was low, it's probably going to go higher than that, and the unemployment rate would be in recession. So these are the different scenarios. And just with that, I mean, these are my forecasts. I've got inflation, as you can see, compared to the Federal Reserve and the Reserve, but these are the forecasts for the US Federal Reserve in orange, and the RBA in orange for the year end in terms of annual economic growth, unemployment, and underlying inflation. And as you can see, I think, importantly, I think inflation is going to come in maybe a little bit lower than what central banks expect. And maybe but I think in terms of unemployment, a moderate increase in the unemployment rate, but nothing that would suggest, you know, a deep downturn, a recession. So this is a sort of, you know, softish landing scenario. Now, so basically, why have we gone from fearing recession, or in fact expecting a recession, to thinking, you know, a soft landing is achievable? And I want to break that question down into two parts. Firstly, what has been a surprise, I think, to many and central banks is that economic growth has held up better than expected despite the rate rises. I think central banks 6 months, 9 months ago would probably, in fact, they were forecasting, certainly the US central bank was forecasting a deeper downturn than we were in at the moment. And a couple of reasons for that is, firstly, the nature of COVID is different from the 1970s. So many people have looked back at the 1970s, seen periods of high inflation, also seen periods of central banks tightening interest rates in the face of that high inflation, but also seeing deep recessions. But I think what was really the driver of the recessions back then was the fact that oil prices increased so significantly in the two OPEC oil shocks that we had. So in a way, the 1970s inflation was associated with what economists call a negative supply shock. It put upward pressure on inflation, but downward pressure on economic activity. So it was easier to get a recession with high inflation back in the 70s. Today, that high inflation, you know, at least up until recently, looks similar, but it's not caused by negative supply shock. It's actually caused by positive demand shock. So demand has been too strong coming out of COVID, and so that's put upward pressure on prices. But, you know, strong demand has kept activity strong. So just in summary, so the nature of the shock that we've dealt with, the nature of the shock that has caused high inflation in the last few years is quite different from the shocks that caused high inflation in the 1970s. The shocks that we've experienced recently have been supportive of economic growth, whereas in the 70s they were not supportive of growth. The other reasons that I think we've also been surprised by the resilience is households built up a lot of savings during COVID due to the lockdowns, due to the fiscal handouts, for a time very low interest rates. And they've been spending into that in the face of weak income growth over the last couple of years. So, for example, in Australia, we've had a major decline in real household disposable income. Inflation going up just cuts your real income, right? If the price of something has doubled, all of a sudden, you know, for the same amount of nominal income, you can't buy as much of that. You've got to, you know, can only buy half of it. And so there's been a big real income hit. Obviously, there's a few other things going on as well, higher interest rates. If household savings hadn't fallen over the last couple of years, we would be in a pretty deep recession because household consumption would have fallen by, you know, between 3 to 5%. It hasn't fallen by that amount. It's broadly flat. So those ability to eat into those savings buffers has been pretty important. Fiscal stimulus, particularly in the US, Joe Biden, unpopular, probably unfairly unpopular because the economy over there is doing very well. He has been encouraging manufacturing onshoring through government subsidies. The green energy transition has really helping a lot of new investment in the green energy sector in the United States. And all of these things have been pretty supportive for business investment and for US economic growth. The other element is that COVID essentially, as I said, was a positive demand shock. We had demand with the reopening of the economy, with the fiscal stimulus. We had demand running ahead of supply. So basically, markets dealt with that by raising prices to clear markets. And one example of that being, everyone wanting to go on a European holiday at the same time. Once we were sort of let out of our homes, Qantas only had so many seats going to the Italian Riviera, and so they jack up the prices to ration demand, and that's essentially what happened in many sectors. Cars, even in the early days during the lockdowns in the goods sector, furniture, cars, these sort of things. And then when we reopened and services, everyone switched from goods into services, we got pricing pressure in areas like hotels, travel, restaurants. But the other thing that's happened though is that we've had a supply recovery as well. So in the goods sector, with the reopening, with the ability of factories to reopen, we've had a positive supply response. And in the labour market, we've had labour supply. Part of that excess demand for services and the increase in services inflation was, yes, an increase in demand for services, but also a reduction in the supply of workers because the labour force participation rate fell, immigration fell, but we've had an economic recovery because that supply has started to recover. And so it's been helped to. When you get supply recovering like that, it's good because it boosts economic activity, but it also reduces the excess demand and therefore puts downward pressure on prices. So it's a pretty nice combination. I guess that's so in terms of why the economy's been resilient, that's maybe easier to understand. Basically the rate rises you've had to date have not hurt economic growth as much. If it turned out inflation was still high, all that would mean is that central banks would have to keep raising rates. Now, the other element to this is that inflation has still managed to come down despite the resilience of growth. And that's maybe a little bit more nuanced. That's where maybe just a need to tease that out a little bit more. And I've got some reasons there. Firstly, a lot of that demand, that strong demand pressure was excess demand. It was beyond ability to produce. And what we've done, for example, in the labour market, we had businesses demanding workers they just couldn't find because we're already at full employment. And what we found is that demand for workers has been reduced without them needing to cut back on their staff. There was still strong demand for labour, but all they've done is just reduce their excess demand beyond full employment. So that reduction in demand, because wages picked up and suddenly they found ways to economise on the need for workers because an increase in wages moderated that demand, and also higher interest rates, these sort of things. That's been able to reduce wages pressures, but it's not come at the cost of economic activity coming down. As I said, the other element to COVID has been the supply recovery, first in the goods market and then in the labour market. So that supply recovery, as I said earlier, has helped to boost economic activity, but also helped to put downward pressure on wages and prices. The other element is, I think, compared to the other thing we thought of, so again, just going back to COVID, the best way to think about COVID is we had a period of excess demand in many areas. Businesses responded by basically rationing available supply by jacking up prices. And it was a one-off price level increase to clear the markets. And so, those the most able to pay the prices, got the goods and the services. But that was a one-off level adjustment. What we'd feared was that would then get embedded into the system through competing wage and price gains, as sort of the thing we saw in the 1970s. But due to better anchored inflation expectations, that hasn't really happened. So in a lot of areas, it's been a one-off price level adjustment, but it hasn't gone on. So, again, airfares, for example, went up 10, 20%. but they haven't gone up 10-20% every year thereafter. They've actually stabilised, in fact, come back somewhat. And that's sort of what we're seeing in many markets. And associated with that, not so much in Australia in some areas, but more competitive labour and product markets compared to the 1970s. For good or bad, the rate of unionisation, the rate of the percent of workers that are in organised labour, for example, is less than in the 70s. So you've had less ability of unions or organised labour to demand big wage increases to compensate for the higher inflation. Globalisation, tech disruption has meant that product markets are also a lot more competitive. Now, just on that, there's a debate, of course, going on in Australia about the degree of competition. We're having a review of grocery prices. So I get, and I've talked about this in the past, it is probably true that we're not as competitive in the United States in areas such as retailing, travel, energy, and as a result, some of those it's been that businesses have found it easier to increase prices in the face of strong demand and maybe less pressure to cut prices back again as that demand, moderates. But eventually that will sort itself out. But it is probably one of the things that is concerning the RBA. Why the RBA at the moment has got less of a desire, or it's signalling less chance of interest rate cuts anytime soon than, say, the United States Federal Reserve, because it's a little bit more concerned about service sector inflation in Australia due to the lack of arguably less competitive markets here. Just to go through some of those elements, I won't spend too much time on this, but this is a chart of the US unemployment rate along the x-axis, the vacancy rates, the job, basically demand for workers by businesses, and you can see that usually there's a negative relationship. So when the demand for workers increases, it tends to put downward pressure on the unemployment rate. We move along that what's called the Beveridge curve. We move along that curve. COVID caused a massive blowout in terms of the unemployment rate. You can see April 2020 there, where the unemployment rate in the US got up to about 15% due to everybody losing their jobs due to the lockdowns and whatnot. Then the COVID recovery has meant that unemployment has fallen, job vacancies have risen, and at the start of early 22, we had very high level of job vacancies and a very low level of unemployment. So at March 22, major excess demand for workers, and the question was, we need to put downward pressure on that on demand for workers because it was causing wage inflation, service sector inflation, and the question was would that downward pressure on vacancies, demand for labour, cause us to move back along that line, those grey dots, and i.e. the unemployment rate increase, or would we vertically shift back down to sort of where we were prior to pandemic? And the black dots in that chart is where we were in 2019, for example. And what we've seen, the incredibly good news is that we have vertically shifted down. So from March 22 to November 23, you can see we've actually the vacancy rate has fallen, but without any major increase in the unemployment rate. So hence why, we are enjoying continued good growth, but a moderation in wages and service sector inflation in the United States. Associated with that has been a nice rebound in labour supply. So this is a chart of the US labour force, the size of the US labour force. And you can see the big collapse in number of workers. We went from 164 million workers, available workers in the US just prior to the pandemic, dropped down to 158 million. So they lost, 6 million workers. And then they've been recovering that, labour force participation has recovered, immigration has recovered, and that has helped, again, just to belabor that point, that positive supply response has not only supported economic activity, kept us out of recession, but reduced excess demand for labour and put downward pressure on wages to a degree. And you can see that here with the wages growth. So the top line is various measures of US wages. It has been moderating. Again, we're not quite back to 2019 levels in terms of wages growth, but it is moderating. And you can see there, I mean, it's a little bit hard to see, but the job openings You can see that it's on the right-hand axis, the lower chart, it's inverted. So when that grey line is rising, it means that job openings are falling. And so they have been falling, as I showed you earlier, but they're not quite back to 2019 levels. So the level of labour demand is still stronger than 2019. But, you know, hopefully, along with a further moderate slowdown in growth, a moderate increase in the unemployment rate, we can get back to something like 2019. And if we do, then we can get back to, you know, lowish wages, lowish service sector inflation, which would be great. But so at the moment, we're not quite there yet, but we're sort of moving in the right direction. And just to, I mean, look, I've shown this chart in the past, but this really just breaks down US inflation. We did get an inflation scare a couple of days ago. If you follow the markets, you would have saw the market sold off on the January US Consumer Price Index, which was a little bit higher than expected. Shows you the sensitivity of the market at the moment to declining inflation. They want to see continued declines in inflation. The CPI number, the underlying measure of inflation, was 0.4 in the month. The market was expecting 0.3, so even a 0.1 miss saw the markets, you know, sell off 1 to 2%. I think that was a bit of a red herring. I still think the broader trend in inflation is down. But again, you know, we're not completely out of the woods. But what I wanted to break it down here is in terms of underlying inflation. The point of this chart is to show why there's still a good reasonable expectation that inflation can continue to come down in the United States. Firstly, you can see goods inflation has done much of the work in reducing underlying inflation at the moment from around about 5.5% at its peak in 22 to now just under 3%. And that's with the resolution of those supply chain bottlenecks, the shift in demand from goods that was, you know, surged during the pandemic when we were all in lockdown, out of goods back into services. So that's good. I think goods inflation will stay contained. Housing inflation, look, I've pointed this out in the past. The housing inflation, rents and house prices, as we're seeing with on new leases and new property transactions, flows through into the measures of housing inflation with a lag. You can see housing inflation has started to turn down the annual rate from around about 8% to just over 6%. But what we've seen in the housing market over the past year suggests that that will continue to ease down to around 2 to 3% potentially over the next 12 months. So the housing inflation, which is, and again, the CPI numbers that we got a couple of days ago, they are different. This is the what's called the core consumption. This is, sorry, the consumption deflator. It's a slightly different measure of inflation. It's the one the US Federal Reserve cares more about because the weights shift a bit more in line with changing consumer spending patterns. And it tends to give you a lower reading on inflation overall because the weights shift more quickly. If prices are going up somewhere, people tend to spend less on that area. And so that's reflected in the weights a bit more quickly. But the bottom line, housing is a smaller element of this measure of inflation than it is in the CPI. So the US CPI, excluding food and housing, so it's more underlying measure, something like 40% of core CPI is housing. Or in fact, I think it's actually 60%. So it's a big chunk of underlying inflation is the housing story. And so that's why the CPI there is still a little bit higher. But in this other measure of inflation, it's a smaller share. So inflation generally is lower. But importantly, in both measures, housing inflation should continue to moderate over the next 12 months. Last but not least is services ex housing, and I'm watching that trend closely. And a bit like what I showed you before with the labour market, it's moving in the right direction, but the job is not yet done. It's not yet mission accomplished. You can see wages growth is moderated from the highs, but we're not quite back to sort of the 2019 levels. Similarly, service inflation has been moderating, but not quite there yet. So, you know, we need to watch that very closely. If that would actually level off, and in fact, you know, service inflation stays around 3.5%, 4%, or heaven forbid, you know, re-accelerates, then, you know, we're no longer in the soft landing camp. We're in the no landing camp. We're in the camp where the Fed not only can't cut rates, it may actually end up raising rates, and it would be cause all sorts of mayhem in markets. But fingers crossed that we won't go into that situation. I don't anticipate that. But just being alert to the risks. And it really does come down to this sort of situation in the labour market, particularly in the United States. Just another element, US oil. So talking about stagflationary risk and the potential for oil prices to go up if some of the geopolitical tensions we're seeing around the world escalate. Now, just to counter to that is the fact that US shale oil producers have been quietly, increasing their supply. So again, one of the reasons why a US economy has remained relatively strong in the last couple of years compared to, say, Europe, is that the increase in oil prices, the increase in gas prices post Russia's invasion of Ukraine is more of a negative for Europe because it's a net energy importer, whereas the US is almost self-sufficient in energy due to the sheer amount of oil that it now produces. And so the oil shock that we had for a time actually obviously hurt some parts of the US economy, but it boosts other parts, particularly those looking to dig oil out of the ground in the shale oil regions. So here you can see that US production has been increasing. And again, a lot of focus on OPEC trying to cut production to support oil prices, much to OPEC's frustration, I guess, is that it only encourages US producers to ramp up production. So I do pose this as a risk. If you recall back in 2014-15, OPEC actually gave up on trying to support prices by restraining supply and actually increased supply. It led to a big collapse in oil prices, and it washed out all the US shale oil producers. You can see US shale oil production fell between 2015 and 2017. And I just pose that as a risk at the moment. A potentially good risk for inflation is that OPEC may change their strategy at some point and actually increase production, and we could see oil prices drop, back below $50, even $30, $40 a barrel, which would help to wipe out some of the US shale oil producers at the moment. So something to watch this year. It's just a counter to some of the upside risks on inflation from the geopolitical tension we're seeing at the moment. I won't spend too much on this. This is just a summary of the global business sentiment indicators. You can see, broadly speaking, they're all okay. I mean, you've got to take the Chinese numbers with a grain of salt, but if you're going around, you can see the US services sector is pretty healthy. The PMI index is above 50. If it's above 50, it means the economy is pretty healthy. The manufacturing sector is somewhat weaker, but it is recovering. And partly what we're seeing in terms of weakness of manufacturing is that they had a big ramp up coming out of COVID as they had to catch up with the demand for all the goods and the rundown in inventories. And now as demand has switched into services, there's a bit of a sort of a readjustment going on. So the manufacturing sector is going through a period of weakness, but I don't think it's a big recession indicator. You can see Japan, things are sort of okay above the zero line in terms of the Tenkan index. Europe has been the weaker part, so Europe's been weak, because of the increase in energy prices, the need to, get around using Russian oil. They've had to use a lot more gas, and the price of that has been higher. And also they're going through a, challenging green energy transition, certainly in the case of Germany, closing down nuclear plants and trying to figure out how to, replace that with green energy, and having to reopen gas plants and reopen even coal plants to some extent in the short run has caused, this big energy shock going on in Europe at the moment. But overall, it's mixed, but, things are holding up, particularly in the United States, which again, ultimately is what matters for global markets. It's whether the US economy goes into recession or not is what will drive Wall Street, and hence what will drive global markets such as our own. In terms of the market outlook, markets are pricing in rate cuts. I might just race through this a little bit more quickly, but markets are pricing in rate cuts. I broadly agree with what the markets are anticipating in Australia, basically 2 rate cuts in the second half of the year. The RBA is not signalling that at the moment, but I think we will continue to get declines in inflation that will allow for that. In the US, the markets are waxing and waning about how deeply the US will cut rates. The Fed have signaled the next move in rates is likely down, but that's talking about 50 to 75 points worth of cuts, i.e. 2 to 3 rate cuts this year. I'm penciling in 3 rate cuts in the US, second half of the year. The market up until recently was pricing in 6 rate cuts, so it was getting very aggressive. I don't think we'll get that many, but in terms of bond markets and bond yields, it almost doesn't matter, because what matters, certainly on a 1-year view, is what the markets expect the Fed will be doing going forward. So if it turns out the Fed only cuts rates 3 times this year, not 6, but the markets end the year still expecting aggressive rate cuts in 25, bond yields can still come down. And I've got 10-year bond yields in the US, which are currently about 4.25, coming all the way back down to maybe 3.25, 100 basis points by the end of the year, and something similar in Australia. You can see there rate cuts have been priced in many countries now, not just Australia and the US. And again, good news for those that own fixed rate bonds. Obviously, it's been a troubling few years. 22 was obviously a bit of a shocker in terms of big negative declines in bond returns as bond yields surged. Last year, not so bad, but still muted returns. But 24, 25, I think, is looking a lot better for the fixed income parts of one's portfolios. And I've got their bond yields. I think they will come down to the low 3s by the end of this year. I won't go into that too much. Aussie dollar, I've got going higher. I'm actually calling 75 cents by the end of this year. It's pulled back to 65. You can see there the orange line. As at Christmas time, around the end of the year, it actually had gone from 63 up until 68 cents on those initial soft landing hopes last year, where it looked like the US is going to start able to cut interest rates. You can see the US dollar in black on the right-hand side of that axis inverted. So that black line rose, the US dollar weakened, and the Aussie dollar strengthened in the final months of 23. But it's pulled back a little bit lately because the resilience of the US economy, the inflation upside surprise we got recently, has meant markets have pushed out when the US will cut interest rates. And as a result, that strengthened the US dollar and it's weakened the Aussie dollar. So funnily enough, strong US economic growth, less rate cuts in the US, no rate cuts anytime soon, which is good for global growth, has been a source of weakness for the Aussie dollar. Usually we like a strong global economy, but because it's mainly in the US at the moment, it's caused the Aussie to pull back. But we will eventually get to the US rate cuts, and as a result, I think that will turn around, and I think the Aussie dollar can strengthen as a result. Because yes, we'll cut rates, but we won't. Over the next 1 to 2 years, the Fed will be cutting rates more deeply than we will, because they raised rates more aggressively than we did, so they have more to unwind. The other important story here is that the US dollar is sort of a safe haven type of currency, and due to the fears of recession that have been swirling for the last couple of years, it's tended to remain strong. And as those fears dissipate, I think the US dollar can weaken, which again supports the Aussie dollar versus the US dollar. Equities, broadly speaking, a lot of focus globally about obviously the big US technology companies, the Googles, the Amazons, and Facebooks, trading at what look like rich valuations. What I can tell you is that outside of the US large cap tech companies, market valuations aren't that bad. So this is the PE ratio for the MSCI All Country World Index versus 10-year bond yields. Look, as at early February, it was trading at around about 16.5 times forward earnings, broadly within the long run range. So I would characterize equity valuations, particularly outside of the US tech sector, as not cheap, not expensive, sort of broadly fair value. And as bond yields come down, those valuations should at least stay where they are and maybe go up a little bit. So from a valuation perspective, I think things look okay. Meanwhile, you've got, if we do get the soft landing, the earnings story is still positive. So you can see their markets are expecting solid growth in earnings in 24. That's the rolling expectation among analysts for the level of earnings in 24 and 25 and 26, rolling monthly estimate by all the analysts that are surveyed. And you can see at the moment, analysts expect the level of earnings in 24 to be well above that of 23 and 25 above 24. That orange line is what's called forward earnings, and that rises as long as the forward expectations for earnings over those future years is positive. And so if those expectations hold up, then that orange line can continue rising. So in summary, when you think about the overall equity market at the moment, valuations are neutral. Maybe they can stay where they are, but markets can grind higher on the back of rising corporate earnings. That would be the backdrop. I won't go through that too much. I just a similar sort of chart looking at Australia markets. Since this chart was put together, valuations have got a bit higher, but around about 16 or so. I don't think is that expensive at the moment, particularly given the outlook for bond yields and inflation. So I think our market also broadly fair value at current PE valuations. Some investment ideas. How many charts have I got left? Again, I won't go through all of this in detail because I'm running it. I want to leave some time for questions, but I will just quickly summarize. To the extent you want to use ETFs and you want to tactically tilt, that soft landing scenario would generally favor the tech areas. So things like the NASDAQ, Asia technology, Australian. For those of you who don't know, we do have a technology sector ETF as well, ATEC. So falling bond yields, good economic growth, usually supportive of high beta, what's called high beta, growthy type equity exposures. And there's a selection there in terms of the NASDAQ, Asia and ATEC. NASDAQ doesn't need any support. It's already doing very well, as is Australian technology. But I think it's playing into the idea that the global economy can enjoy the soft landing. Just some other ideas from other types of exposures. I just highlight maybe if we do get a recession, things do get weak. Then you've got a bunch of fixed rate bond ETFs. AGVT is Australian government bonds. GG is global bonds. So we have a range of bond exposures. Won't go through the rest at the moment, but at the moment, I'm counting on that soft landing, and it will tend to favour those areas. Now, one counter to the view that just go technology is that if you look at this slide, the tech sector, and I'm focusing here on the NASDAQ. The NASDAQ's not all technology, but it's a good representative of sort of growth and the sort of tech sector. And you see it is trading at it's trading at above long run average valuations, not too badly. Certainly nowhere near the valuations we got during the dot-com bubble 20 odd years ago. The NASDAQ on a trailing earnings basis actually reached 68 times earnings in early 2000. Today it's trading at 32, so about half that. But it is above average, but I would say not terribly above average. So a lot of the performance of the NASDAQ, of the US tech sector, has been earnings driven. Yes, there's been some valuation upgrade, but it's mainly been an earnings story. And part of the reason it looks expensive is that it's certainly relative. The rest of the world, and I've got there the world ex the US, looks pretty cheap. So, as at the time I put this together a few weeks ago, it's down at 14 times earnings. So the NASDAQ is trading at above average long run PE valuations. The rest of the world is traveling at a little bit below long run. And as a result, that premium looks relatively high. So the bottom chart there is the PE premium of the NASDAQ versus the rest of the world, or ex the United States. Is it a premium? Not quite at dot-com bubble levels, but nonetheless looking pretty expensive. So there is I think many investors, and we talk to many investors around the country, financial planners and other fund managers, and reading the financial literature. Even though a soft landing does favour the tech sector, you may well see a rotation to some of these cheaper areas, things like small caps, for example, things like emerging markets, because they are at the moment, relatively cheap. So just something to bear in mind. Look, with that, I'll leave it there. There's some other, basically a lot of things that are elaborating on that theme. If you go through the relative performance of markets, these are relative performances against, you can see, growth has been outperforming value. The US market's been outperforming non-US markets. Emerging markets have been performing poorly, and small caps performing poorly. So it's really been US large cap tech versus the rest. But maybe, so far we haven't seen that major rotation out of that trade, but that could be something to watch in the months ahead. I will leave it there and open it up for questions.
Thank you, Dave. Another insightful session as always. We've had a number of questions come through and some pretty consistent themes around interest rates, inflation and geopolitical tensions. I'll kick off. There's currently, Dave, a number of flashpoints around the globe. Geopolitically, do these flashpoints pose any risks?
Let me talk on the geopolitical risks and expect exactly what we're concerned about. So in terms of the geopolitical risk numero uno, Russia's invasion of Ukraine, we've been fearful of an escalation, beyond the Ukraine. That hasn't happened so far. And, the rest outside of the Ukraine, those countries are covered by NATO. And so, according to the NATO treaty, if Russia were to invade some of these other countries like Poland and whatnot, they're not going to do that because, the rest, Germany and France and even the United States at the moment would have to intervene. So I don't anticipate that sort of escalation. When and if, I haven't mentioned Donald Trump, but when and if he comes to power, we'll see if he does ditch the NATO treaty. I don't think even Donald Trump would do that, but you never know. But what we've been fearing in that area, and also in the terms of Iraq, in terms of, sorry, not the Hamas, the terrible situation in Gaza at the moment, we've been fearful of an escalation. We've been fearful of a disruption to Iranian oil supply, important source of oil exports, and even Russian oil supply. In both cases, those conflicts have remained contained, and the supply of oil from both Russia and Iran has not been disrupted. So that's so obviously you've got to watch that, but so far at least those geopolitical risks have been contained. Other sort of risks people talk about is, China and Taiwan. Look, that's just a simmering issue. I don't think China's in any position or desire to start going down that path. It's got enough economic problems at the moment to deal with, which I haven't touched on. The other, I guess, geopolitical risk, to be honest, is what would happen if Donald Trump did win in November. You can break that down on a number of levels. Firstly, I think markets are a lot more comfortable, at least in terms of economic policy under Donald Trump. He is for low taxation. He's for light regulation. So Wall Street, I think, is more comfortable with him taking over if that were to happen. Then there's a whole issue about what he does do with peace treaties and whatnot, and whether that encourages more Russian ambition in Europe. But that's maybe an issue for months down the track there and after if he wins.
Okay, and just moving on here. So, David, we keep hearing that interest rates have peaked and we are seeing rate cuts priced into the market. We've had some questions on what the next cyclical low in rates will be, and are you able to provide some insight there?
Yeah, well, I mean, the cyclical low, obviously depends when and if we go into recession. So what I would say is I think that there's a lot of debate at the moment about what is the neutral rate, what is the long run expected average cash rate? Has it gone up? But my bottom line answer at the moment is no, I don't think it has. So I think in both the case of Australia and the US, central banks think neutral cash is around about 2.5%. So all things being normal, if inflation is back in the target band, growth is at trend, and unemployment is close to full employment, if we're in sort of an equilibrium type of economy, then we may find that interest rates around about 2.5%, maybe 3% would be the sort of long run expectation for the cash rate. If we go into recession, we'll go lower than that. They may end up cutting rates to zero. So the cyclical low, ultimately yeah, I mean, in a recession, it could go lower. So I think the more interesting question is what is your expectation for the long run neutral cash rate going forward? And I think it's certainly lower than where it is at the moment. And so a normalizing of interest rates today is rate cuts. Whereas, a few years ago when rates were, near zero, normalization was rate increases. That's probably all I can really say on that front at the moment.
Okay, so moving on again, especially with the idea of a soft landing in mind, what markets or sectors are better off given the potential of a soft landing, and are there any sectors which could be worse off?
Okay, so generally speaking, I think technology, growth, quality. I mean, these are sort of the exposures we have, like the NASDAQ, the NDQ ETF. We have a global quality ETF, QLTY and HQLT, I think, which is a hedged version. These are areas that will do well in a soft landing environment. Quality companies are those with above average return on equity, generally punching out pretty good earnings growth. So you can get a low cost ETF for those types of exposures. And in case of Australia, a little bit, but everybody talks about Australia being, banks and mines. That's definitely true. They dominate the index, about 50% of the index. But there are some nice growthy exposures within Australia. So we have a quality ETF, companies with above average return on equity, AQLT, and ATEC, ATEC, which is an Australian S&P technology index. And so these are ways to, just through a simple ETF, get some nice growth exposure even within the Australian market. So they are obvious ones in a soft landing type of environment. I do mention things like small caps, emerging markets, simply because they look relatively cheap. Japan is another one. I didn't mention Japan, but Japan's been doing pretty well. It's one of the few areas outside of US tech that's actually been outperforming global markets. The Japanese corporate earnings story is pretty positive. Companies there are, cleaning up their balance sheets, focusing on shareholder returns. And so for a given level of revenue now, they're able to generate more earnings because they've got a more focusing on shareholder returns. So what won't do well? Look, in a soft landing, there's few things that don't do well. Look, in a summary, as I said, in a soft landing, bonds and equities can do well. So the sort of cash, hunkering down in cash is probably, this is a time to, assuming, that is the central case scenario, then, getting exposure, hunkering down in cash. So going back to 22, when both bonds and equities did badly, you'd want to be in cash and floating rate bonds, those sort of things. Whereas now when, bonds and equities look good, it's maybe time to rotate out of those into some of these other areas.
A big thank you for today. Thank you to David for a never insightful session. I know we didn't get through all the questions, so like I discussed, jump on any of our socials and shoot those questions over to us at any time. You've got the QR code on the screen, so do subscribe to our weekly insights as well. You will receive a recording by email, as well as it'll be available on the website as well. A big thank you again, and we look forward to catching you in the next 3 months session.